Well, welcome to our session today on the art and science of capital structure. And one of my best friends for decades was Merton Miller, who won a Nobel Prize, had a great sense of humor, from the University of Chicago. And Merton did work saying that the capital structure did not matter in valuations. And about 22 or so years ago, we had these Miller-Milken debates. Now, Merton is not around to tell you who he thinks won, therefore I will have to be forced to tell you that I think it was 10 to Milken, 0 to Miller. But I mentioned to Merton that he was actually correct, that on one of the moons of Jupiter, without an atmosphere, capital structure doesn't matter. But here on Earth, capital structure does matter a great deal. And I've brought my security blanket that I carry with me at all times on how do you finance a company. So it starts with understanding the company and who the employees are. And so having good management, which I'm sure some of our panelists will talk about, is essential how you build that capital structure. And when a man like Steve Ross headed Warner, he was extremely comfortable with different forms of capital structure and changing it, and therefore starting with the company and the employees of the company. And his leadership, you can have a complicated capital structure. Unfortunately, after Steve passed away, you really needed to simplify. The next one is kind of the industry when you look at your cube. And when you think about an industry, some industries have enormous volatility, particularly in technology where you could be disintermediated in 2 or 3 years. So you'd want to have less debt in that capital structure. And other industries can allow more. Next, understanding capital markets. And as I'm sure our experts are going to tell us, the best time to finance is when you don't need money, and the worst time to finance is when you do need money. Then what you think about going on in the economy is important. Then regulation. And as Bill McGowan, former CEO MCI, used to tell me, that AT&T introduced regulation every day that would put them out of business. And then the most important factor that you never learn in a university is society. Does society think your business is valuable? Do they think you're making a contribution? Because how society feels about you, and I'm sure Manny's going to talk about in a few minutes when I call on him, but really, how do they feel about your industry eventually leads to regulation. So Manny, when we think today about the financial service industry, in many ways it would not rank high in popularity by the public.
No, banks are considered evil, big banks.
And as you, as one of the major investors in the world in financial institutions and building financial institutions yourself over time, how do you look at financial institutions? How do you look at their capital structure? And maybe take a look back over these volatile periods we've had and as to how you've chosen to invest in financial institutions.
Sure. Before the 50s, capital structure, in the 60s, capital structure was very, very simple for banks. They had deposits and they had equity. Then we began with some debt, very modest amounts of debt. The revolution began in the 1980s, where the banks or the regulated financial institutions were allowed to put different forms of debt on and count them as equity, starting really with non-cum preferred. And that was part of the reason we ended up in 2008 with some big banks in the United States with 1/4% of their capital was equity. So the capital structure of a bank or in a financial institution that's regulated by the government, is controlled by the government. Because of the collapse of the United States in '08, it's extremely controlled by the regulators.
So, Mitch, your firm invests throughout the capital structure. Why don't you give us a feeling for Canyon, how you look at capital structure as an investor? What parts of the capital structure do you invest in?
Right. So I think we go a little bit beyond just looking at the capital structure. I think your cube implies this because we look at the whole balance sheet, obviously. And right now we think balance sheets are going through a lot of change. We think that low for longer environment really causes companies to take advantage of opportunities to change either the left side of their balance sheet, spin-offs, mergers, whatever, or change the right side of the balance sheet, or do a combination of the two, re-leverage, deleverage, etc. And obviously we focus on micro balance sheets, whether it's corporates or residential mortgage-backed securities, aircraft securitizations. But we also, when you think about balance sheets and capital structure, have to pay attention to macro balance sheets. I'm going to give you a little example of why it's so important. Dan Ock, fellow hedge fund manager, said, if you don't do macro, macro will do you. So if you look at slide 6, let's talk about a macro balance sheet in Europe, which is going on in terms of a drama right now. So if you pull up slide 6. Okay, so here we go. Angela Merkel arrives at customs in Athens, and the clerk asks, name? Angela Merkel. Residence? Bonn, Germany. Occupation? Not this time, just a holiday weekend. And so what's the moral of this? The moral of this is that in the Eurozone, you have different balance sheets with different capital structures, different assets, tied together through imperfect structures, institutional structures, and one currency. And that creates a lot of problems. And to the extent that you don't pay attention to that, you can really get caught in those macro dynamics. So I'll give you an example of what we as alternative asset managers are doing. If you pull up slide 7. I have to be very careful about my movie references because as you get older, most people don't remember them. But that scene from Jaws, I think, is pretty iconic. Essentially, I think both sovereigns, central banks, and guys like us in the shadow banking system and money center banks are trying to get a bigger boat. That is a better balance sheet. Part of that involves capital structures. Part of that means repositioning their assets. So a couple of last things that I'll point out. If you pull up slide 18. Okay, so if we look at the structure of the financial system, this is what I think is going on. You have synchronously, all the central banks are expanding their balance sheets. They're essentially creating an insurance policy to keep the fragile financial system intact. That's, in other words, they're issuing insurance against left tail risk. Who is paying for that insurance? Money center banks. They're being forced to deal with litigation. They're contracting under Basel or other regulatory regimes. So guys like us in the shadow banking system, whether it's Apollo, Blackstone, Canyon, have opportunities because of the gaps and cracks in the financial system. So we get to play where these money center banks, these big balance sheets, are not allowed to play. And as Mike pointed out, that's all over a capital structure, whether it's leveraged loans, high-yield bonds, preferred, convertibles, or equity. And our job is to anticipate what the next change in a balance sheet is likely to be. We try to sometimes put on our investment banking hat or corporate finance hat. We learned that from Mike. As an investor, you apply those tools and you try to precipitate a change. Or you develop great relationships on the buy side and the sell side, and you participate in the deals that they're increasingly giving to us. So it's a little mantra we use: anticipate, precipitate, participate.
Very nice there.
Thanks, Mike.
So, Mark, you've played a little different position here in a sense, particularly in the growth of the mezzanine loan. So you're somewhere between equity and more of the senior part of the capital structure. We've recently read that GE is going to exit from providing capital to companies, wind down much of what was GE Finance over the years, which at one time might have been their largest source of profits. How is your firm, Crescent Capital, responding to that, and what are the opportunities for you?
Thanks, Mike. And by the way, before I talk about Crescent, I'm wondering if I can get a couple of these beanbag things from my kids' rooms. I think they could benefit from starting to think early about capital structures and finance. Actually, we probably could use that as a Crescent, frankly. At Crescent, we manage about $18 billion, and fully half of that is private capital, and because it's private, it allows us to address companies' needs or capital structure needs, uniquely in each case. I think we're best known, as Mike points out, for mezzanine finance. Over the last 25 years, we've invested over $10 billion in mezzanine finance, and mezzanine is a broad category. It's pretty much everything below bank debt and above equity. But in every case in our firm, whether it's mezzanine finance, direct lending, or European specialty lending, we're meeting with companies and trying to address their needs through private loans and private investments, and then address our investors' needs. The reason we've, I think, grown to the extent we have over these past few years is some of what Mitch is pointing out, the shadow banking system, and some of what's pointing out we have public markets that are quite frothy. I know John Sokolov's going to talk a little bit about the benefit buyout sponsors are getting at issuing debt at 5%. At Crescent, we try to issue debt between 7 and 15%, but do it in a way that is constructive for our clients and address their needs. Sometimes that's a senior loan, sometimes it's a unitranche loan, sometimes it's an unsecured mezzanine loan. In each case, we try to custom tailor a capital structure to a company's needs, and in doing that, think a lot about the things that Mike has in his cube here to come up with solutions.
John, today you run a private equity firm, a very successful private equity firm, and I'm happy to be a limited partner at Leonard Green. You are interacting with dozens of companies at one time. My guess is yours and your partner's expertise on capital structure might even exceed that of the companies you invest in. How do you interact with those companies?
Well, first I want to thank you for having us on this panel, and I want to remind the audience that three of us on the panel were privileged to have probably the best finance professor in the history of the world teach us the business. Myself, Mitch, and Mark started at Drexel about 30 years ago, and most of what we practice today we learned from Mike. And so that gives us an edge in the markets. And again,
neither of you have changed, John.
Yeah. So look at this. Mark and I. Well, Mark, go ahead. This is your picture.
John and I shared a windowless office next to what was then called the Xerox room in the corporate finance department at Drexel, and we worked on a recapitalization back in the mid-'80s, actually with Mike and Welsh Carson, that was quite successful, and I guess got our picture in magazine there.
That was the deal where Mark and I were working on the deal, and then between roadshow and pricing, I went off on my honeymoon and got married, and that was before cell phones and all that. So Mark was nice enough to carry the deal through, and it worked out to be a great transaction. But our view is a little different than some of the other panelists. We're a private equity firm, and we have about 30 companies in our portfolio, and it's our job to both determine what these companies are worth and then hopefully buy them or invest in them, and in the process determine what the best capital structure is for that business. And it's certainly not one size fits all, and there's every deal has a story. You know, we're very fortunate all to be living in a time of really all-time high equity markets and all-time low interest rates. So it's kind of a feast for those of us that come from the old days in the 80s and 90s when we were borrowing money at 10, 12, 14%, and our leverage had heavy amortization, covenants. It was very lender-friendly, and borrowers constantly lived in fear of pissing off their lenders or crossing over the line. So the reality is the leverage we use today bears virtually nothing in common with the leverage we used 10 or 20 years ago. It's a dramatically different balance sheet technology. Now, when we sit down with our management teams, 9 out of 10 people say, well, we don't want a lot of debt. We don't like debt. Oh my God, well, we really used to be called a leverage buyout firm. That's a bad word now, so we're called a private equity firm. We do use a lot of leverage, and part of what we have to do is educate management teams who are very sophisticated at running their business, but often shockingly unsophisticated in the financial markets. What is the debt technology today? And get them comfortable that debt can be your friend and debt can be a huge creator of equity value rather than a destroyer. So we're kind of proselytizing or evangelists out there saying, how can we help your capital structure? So we can borrow today often 6 times EBITDA at 6% interest pre-tax. The government pays 40% of the load, so you're paying under 4% after tax, long maturities, no amortizations, no covenants. You're awash in liquidity. We used to often manage the Lotus spreadsheets back at Drexel to try to get the coverage ratios to EBITDA to interest 1.3x, 1.4x, 1.5x. You were like AAA. And today, often our coverage ratios are 3 to 1 going into a deal, leveraged 6 or 7 times. We're often paying more in taxes than we are in interest, where in the old days, between interest and depreciation and the old accounting rules, our companies virtually never paid taxes. So, you know, it's an interesting time. We also go out, we visit with a lot of public companies who we think have the wrong capital structure because they may not be quite as high growthy as they are, and sometimes you can borrow their entire equity market cap in the credit markets. And we kind of take them through a series of analysis, which is always very eye-opening for these large companies, that how today, you know, debt can be your friend. Now, on the other hand, today the equity markets are overvaluing growth. So if you have a really high grower, you probably want to have more of an equity-oriented capital structure, and you might trade at 30, 40, 50, 100 times earnings. So, you know, Mike taught us the capital markets are your friends. If you're a company and your stock falls, don't cry about it, buy your stock. You know, if rates fall, issue debt. So it's a very dynamic situation, and it's our job to work with our 30 companies and management teams in helping them about how best to access the capital markets to have the best capital structure.
Mike, I'd like to put in context a little bit what Mitch said, but paint a much broader canvas of why investing in European shadow banks or creating European finance companies is really one of the most unusual opportunities. Keep in mind where we are today. We have a GDP in the United States of $18 trillion. We have a GDP in Europe of $16 trillion. You have a banking system, United States, with $16 trillion of assets, and in Europe, it's $45 billion. 3 to 1, 3 times bigger. And on top of that, the banking system in Europe has 4.5% capital. The banking system in the United States has 8.5% capital. Throw the gasoline on the fire, and Europe banks are funded by 50% deposits, U.S. by 85% deposits. So there's a lot of wood to chop in Europe, meaning that the banks, which completely dominate every aspect of the industry, are withdrawing across the board. So there's an unbelievable dichotomy between great, strong credits and middle market credits or weaker credits. In the United States, if you look at slide 45, in the United States, that vacuum is filled by finance companies In Europe, it's the desert. There are no finance companies. There's funds that invest, but I'm talking about operating companies. Because in the long run, the operating company will disintermediate the hedge fund investor, period, because it has cheaper capital. So the great opportunity is in doing two things: finding finance companies that are already operating, that are growing rapidly, that have this unbelievable advantage against the banks, because they're not even allowed to do half these things anymore. They're prohibited or forbidden, or they're forced out because of capital requirements. Or number two, create those companies from the ground up with a strong operator or through private equity or however, but the true growth is in the public market.
One other thing, though, Manny, is in addition to the holes that exist, or as I said before, the gaps and cracks in the financial system, which are particularly wide in Europe, there are two other things you can do, which is buy the assets that the big banks have to sell. There was 36 trillion. Now it's down to 32 trillion. They got another several trillion to go through. So we've been buyers of what they have to sell. So real estate, we buy through the debt. We've owned 2 hotel chains. One we sold already at much higher prices. Another, we're considering selling in Ireland and the UK. So there's a variety of things that you can buy from the left side of these huge balance sheets that are out of proportion with the nature of the economy in Europe. The second thing you can do, instead of starting up a specialty finance company as you're describing, which I think is a great opportunity.
When I say starting up, I really mean you're combining with an existing operator.
Right.
So whether it's taking Gramercy and taking them, who is a triple net lender and has their own group in London, and simply providing the capital for them to become a triple net lender in Germany and Netherlands, where you get 7-8% on a triple net lease, and you borrow 10-year money at 1.8%. It's
right.
those rates that drive the return.
It's huge. There's a huge opportunity. But in addition to these emerging or participants, whether they're existing or emerging in the shadow banking system, which was much more underdeveloped in the Euro system, there's also the idea of selecting both the winners and losers in the Eurozone. So for example, you could buy a loser, a company that is going to go out of business, and you do the liquidation analysis and you buy the debt and you figure what stream of payments you're going to get from that loser. That, in other words, they have no role to play. We did this with a consumer finance company in the UK, and you make a winner out of the loser.
Well, let me just step back.
Oh, one last thing.
Go ahead, Mitch.
So the last thing is, on the other hand, there are big banks that you can invest in at different layers of the capital structure, the COCOs, the equity, and some of those banks are not properly valued and will survive. So a winner that you can make a winner with the right investment.
Okay, so let me just paraphrase to set the stage. Interest rates are lower in Europe than the United States. You have industrial companies' debt trade, in some cases, 2% lower in Europe than the US, so you can borrow cheaper.
Right.
Manny is pointing out that the bank assets are too large in Europe. They're still too large as a percentage of the GDP. So US bank assets are less than the GDP.
Mike, it's not just that the bank assets are too large. It's the fact that under the new rules, the banks are not allowed to make certain loans. They're forbidden from making certain loans. Or if they want to make certain loans, they need to put up 300% capital or 200 or 100. So it goes much, much deeper than just the fact that the banks are too big. It's the fact the regulations, which you're pointing out here on this cube, completely dominates it. So they're being forced out. When you think of a big bank in Europe or United States, you should be thinking of Con Edison. You should be thinking of a public utility, because that is the regulatory goal. That is what's being done every single day in terms of imposing those rules on every big bank in the United States and in Europe.
Okay, so I hadn't gotten there yet, but you've taken me there.
That's a first.
So a lot of assets, trillions. The change in regulation, and Manny, until the last 2 months, I was at our Center for Financial Markets, which is in Washington, the Milken Institute, and for the first time, I think 60 days ago, I heard that we should make our banks utilities.
They are making them utilities.
And so therefore, as Manny pointed out, by requiring reserves, I can make that loan that you can't generate a rate of return on. The same thing on a revolver. If I charge you for having a commitment outstanding, but it's never borrowed, you're not generating any income, but I'm asking you to allocate capital. So the revolution you're talking about, what is your firm doing to take advantage of this, Manny?
Well, the number of finance companies, if you look at slide 45 or 46, there are no finance companies in Europe. There are 6, 7, 8. We're cornerstone investors in some of the new ones. We are investors in other ones that are existing, and we are creating new ones with partners. So it's, there's a double and triple way of investing through this way. There's also can go Mitch's way, which is, buying the assets directly. But in the end result, the real money will be made in the operating company, the same way the real money in the United States was made in the operating company. It's not a trade. It is creating a business. It has to be created, period.
Now, Mark, let's go to you for a moment. GE is getting out pretty much of the finance business.
That's great.
But as we all know, it's really the people. So a company can get out of the business. Are you focusing on any of the talent at GE, and how are you looking at this opportunity?
I'd like to talk about the power of human capital. And Mike, you taught us that you were talking about the power of human capital in the 1980s. One of the benefits we have now at our firm for where we are in our life cycle,
Manny,
around $18 billion and 20 years plus into our maturation, is that there's still a lot of entrepreneurial opportunity, but little downside professionally. So, every week we're getting resumes from professionals, and this isn't a billboard for that, but every week we're getting resumes from professionals, including some of potential GE refugees. We have folks who have worked for us who've been at Wells Fargo and Fleet, and we've seen this cycle before in at different times. And then the opportunity, whether it's in the U.S., because companies even as big as GE are getting out, or what Manny talked about in Europe. And Manny, I'm going to see if I can license your video from this and use it in Crescent Marketing for our European specialty lending business.
For a payment, yes.
We'll work that out. The desert, I've never heard it described so graphically or so perfectly, but there is really a desert in Europe. There's an enormous opportunity. The challenge is to communicate to investors what that opportunity is. What it translates to on a micro level, hearing what Manny and Mitch are saying on a macro level, is that we're making senior loans in Europe at 10% rates of interest. So you look at the very, very low interest rate environment around the world, yet in Europe we're lending money at under 4 times cash flow, senior at an average rate of 10%, and for companies in Michael's cube here that are socially needed. One of our recent investments is for a group that provides nursing services in the UK, which are desperately needed. There's a lack of nurses to go both in-home and even to hospitals, and we financed a company that does that. So there's enormous opportunity day to day to make loans to companies and businesses because of this macro backdrop. And to find talent, because folks don't want to work in large institutions anymore, whether it's GE or otherwise.
So, John, Mitch, to paraphrase Mitch, and you can correct me, Mitch, basically he told us that you might have a triple C, but at 30 cents on the dollar, it might be a triple A. So as you're looking at investing, even in liquidating situations,
Right.
what flexibility do you have at Leonard Green to invest in companies? Can you buy stock on the open market? Can you buy their debt? What restrictions do you have?
Yeah, so we're fortunate in that we have a traditional private equity fund. Our most recent fund is $6.25 billion, but we have tremendous flexibility in our agreement to buy a very diverse group of securities. So 2/3 of what we do is traditional equity investments and control leverage buyouts, but that leaves a third, which is a pretty big piece, and we do a very, very diverse amount of investing there. And we do, we'll invest in growth equity, we'll invest in pipes. We did a very successful pipe in 2008 in Whole Foods when the world was ending, and pipes were a terrible, terrible word because billions had been flushed down the toilet in the dot-com era in pipes, and we did an 8% convertible preferred, up 35%, where we felt we were safe in the balance sheet. No matter what happened, we'd get our 8%.
Now, John, there might be someone in China watching this panel, and they might not know what a pipe is, and now you've mentioned flushing it down the toilet. So I think, why don't we talk about what a pipe is just for a moment?
Yeah, so
It is the global conference, after all.
Yeah. A pipe, I think, is a private investment in a public security or something like that, where it was a security that was customized for us, linked or convertible into a publicly traded equity security. And tremendous amount of tech companies used them at the turn of the century. The underlying companies failed, so even the protection of seniority in a preferred status or something else was of no value. We felt strongly in Whole Foods, which is a U.S. natural food supermarket chain, that being senior to all of the common stock was of tremendous value to our investors, and no matter what happened, we'd get our money back, and we get 8%, which happens to be the hurdle in our fund. So it was very advantageous. We buy public stocks, we buy public bonds. During the financial crisis, we took numerous positions in public debt and equity securities where we would hope to have turned them into a control position in the company. In some cases that worked, in some cases it didn't, and we sold our securities at a profit. So that gets back to what you taught us 30 years ago, is to be nimble, to be scrappy, and being able to find places to invest your capital in all different capital market environments. Now, as far as some of the other comments here, it's interesting because we're a borrower, and we used to think very much, who's our lender? We're very concerned about our relationship. Generally now when we sign a loan agreement, the only relevant point in our contract with our lenders is to pay our interest while the loan is outstanding and to pay them back at maturity. There's really no reason to have any discussion with your lenders over anything for the life of the loan. Contrast dramatically to 20 or 30 years ago where you lived in fear of having to talk to your lenders all the time. So to some extent, we're much more agnostic on who our lenders are today. And there's so much turmoil in our lender base. We can't keep track of the Fed rules here, the European rules, what the Japanese are doing, the BDCs. So we have to call a larger number of financing providers today in the hope that 2 or 3 of them will give them the kind of credit we want. And we'll hear Jeffries has a loophole in the regulations, the Canadians have a loophole. So we'll call them all, and thus far we've still been able to put the capital structures together that we desire with good amounts of leverage, but there's really chaos in our view in the lending world, and we have no ability to predict who's going to be the lender that shows up with the capital because their regulators seem to be changing their mind all the time. Now, in general, we still do value relationships. So, we've been the biggest lender, I think the biggest customer of Crescent Capital for 20 years. And one of the beauties of that is that things always change in our companies. You do an acquisition, you go public, you didn't anticipate it in your indenture or your terms. And when you have a situation like that, you can sit down and you have a discussion and say, hey, we didn't really think about this. Why don't we change this and why don't you change that? And why Crescent and others have been great partners of ours is because you can sit down as a reasonable businessman and change things. So in the mezzanine world, it's probably more important. In the senior debt world, we never know. We get a list of who the lenders are after we syndicate a $1 billion deal. We've never heard of half of them.
Yeah, I'd like to point out that for our investors that we do have a covenant or 2 in our documents. And
not like the old days.
Including in the Leonard Green deals, and we get board observation rights so we can have routine conversations. And if some challenge arises, then it's not an event, it's part of an ongoing dialogue. But importantly, I think what John's saying is right. In the larger capital markets now, it's a little bit of a feeding frenzy, and it's an issuer-dominated business, both for bonds and loans.
John, let me just ask John one question, Mitch, and I'll go to you. We have had many politicians tell us, never let a good crisis go to waste, okay? And unfortunately, a lot of regulation has occurred because of crisis that was maybe misguided in many cases. And so one of the downsides of having volatility and crisis is that you have new regulation put into place. But there's also positive sides. And John, maybe you talk about, from an operating company level, the discipline on cost and running a business that was forced on many of these companies during the period of time from 08 to 11, let's say.
Look, I think, 08 and 09 was a fascinating time because for 20 years we had tried to probably get our companies to collaborate and work more together in the hope of saving money and joint purchasing or best practices, whether it was FedEx versus UPS or IBM versus Oracle or whatever. And a lot of companies had a pretty, they were kind of a very high view of themselves. And that all changed in 08, 09. And everyone really was humbled and said, maybe we're not the best at everything. Maybe we can learn from others. And we found across the board, our management teams became much, much better listeners after 2008 and 9, and much more realistic as to what they did well and what they might be able to do better. We had a company that told us they were the greatest in everything. They joined a shipping and freight consortium we had, and they saved millions of dollars, and the CEO said to me, gosh, I thought we were great at that, but we sucked at that, but I didn't know that. How am I supposed to know anything about freight?
Now, John, you've used that word, suck. Not everyone in the 100 countries we're broadening to maybe knows what you meant by that.
It was not their strength. They're not their core competency. But I think it's really been a dramatic sea change. As we are students of companies and management teams, again, we have 30 plus companies, and I think companies are much more focused on cash generation and being free cash flow positive than ever. The costs that we're running out of businesses during the crisis are still, in many cases, out of the businesses, which is why today corporate America is awash in profits. In many cases, profit margins across the board are at all-time highs. Companies are generating massive amounts of free cash flow. So I think the lessons learned from the financial crisis have been, in many cases, huge positives from our portfolio. And it wasn't so much regulation or the government coming in and imposing things. There's always that, whether it's labor laws or environmental concerns. When it was really just businessmen realizing that they can do things better. And part of our formula in our family is we don't have one of these command and control styles where we direct our companies to do things. We have more of a suggestive and collaborative environment where if you put people in a room together, some smart people, and how can we work better and save money? God, they're much more open to that today, and everyone's been a better company for it.
Mitch?
So on the regulatory side, there are situations where regulation provides a tailwind instead of a headwind. So for example, in October, when oil prices collapsed, you had a lot of energy stocks and highly leveraged energy companies really fall precipitously along with oil. And as is typically the case, other industries, related industries, get thrown out like the baby with the bathwater, right? So alternative energy, solar. The thinking was sort of, automatically was that if oil prices go down, gas prices go down, well, people won't install solar panels. So what we did, instead of buying into the old energy, we bought into new energy. So we bought a number of these solar alternative energy companies, whether it's Sun Edison or Solar City, which have the tailwinds from many places regulatory-wise. There's subsidies, which we all pay for. And by the way, people have not seen their utility bills go down along with oil prices because it's a different source of power. So you have the benefit of subsidies, number one. Number two, in the low for longer environment, this goes back to the art and science of capital structure, you have a big incentive to engage in opco-propco kind of situations. So you basically create all these installations, whether it's at the residence or power companies that run on solar, and then you set up, as SunEdison has, a yieldco type company, which has recurring revenue from the installations and the contracts, et cetera, et cetera. And in this low for longer environment, the capital structure arbitrage between an opco and a yieldco is huge, along the lines of what everybody has said. So to make it a more general statement, the point is that as value investors, whether we're on Jonathan's side or some other Manny's side, et cetera, what we do as value investors is we take our understanding of balance sheet dynamics and apply corporate finance, investment banking skills to figuring out what is going to happen next with that capital structure, that balance sheet. And in today's world, you would think at this late stage of the cycle that balance sheet change should be more muted, start to attenuate. But the truth of the matter is it's only accelerating. Now, the pricing is different than 2008, 2009. So we're all having to sharpen our pencils, figure out where we should selectively do things. But it is occurring more and more. One last example, gaming. Opco-propco. You see that going on right now. As a matter of fact, that's with a highly leveraged company or an unleveraged company. So for example, one of the dynamics to get Caesars out of bankruptcy, where we're playing in different levels of the capital structure, is to engage in that opco-propco structure, to take advantage of the low for longer environment and this arbitrage between having property and the yields associated with rental flows versus the operating management part of the business.
Yeah, so just to Permich's point, you know, the opco-propco has been a attractive vehicle for our industry. We're currently buying a public company in a going private transaction, and we're paying 10 times EBITDA for it. And the company has a very, very large amount of owned real estate, and we're able to take 25% of the enterprise value of our purchase price and sell it at a 6+ cap rate. So you're selling cash flows at 16 times with no tax leakage versus paying 10 times for a business. So it's a tremendous arbitrage, and you buy your going in multiple down and create tremendous value going in. And we've done that selectively historically when there's a significant real estate asset. Now, you don't want to overburden the operating company with rent or expenses. You want to do it in a fashion that the company can still comfortably operate. But, you know, I want to say one more thing, Mike, about your question on regulation. Probably the biggest issue on our company's minds from a regulation today in our country is the cost of labor. And many of our companies have very, very large numbers of relatively modest paid people. And often, you know, what separates a good company from a great company is a great company can get extraordinary performance out of unextraordinarily paid people. It's kind of the secret sauce. It's really tough to do, and some companies do it really well. But right now, when I sit in board meetings, I hear all about the Affordable Care Act, and now I'm inundated with minimum wage discussions everywhere. $9, $10, $12, $15. And, you know, our companies are generally very socially conscious. They're mission-driven. Their first stakeholder is their employees. Their mottos are, if we take care of our employees first, the shareholder will ultimately benefit more. But, you know, businesses are very ingenious, so there's all kinds of ways people are dealing with it. They're not just paying higher wages and paying all the affordable care stuff. What's happening in healthcare is that very quietly, deductibles and copays are appreciating dramatically for employees. It's kind of a shadow tax going on in America right now. And as far as the minimum wage, many of our companies pay significantly more than that, and they want to, but they're in the middle of exploring dramatic ways to reduce labor hours in their businesses, automation, new technologies, self-checkout. So there's kind of a revolution going on right now in America on how to manage your labor hours, because even companies very sympathetic to, we need a fair wage, 15 and 15, whatever, are still running businesses, and it'll be fascinating to see how that plays out in the next decade.
Thanks, John. I want to step back for a moment. And if you look at employee job creation in the United States versus Western Europe, and you take the 30 years between 1970 and 2000, first in the United States, you had 62 million jobs created by, quote, non-investment grade companies, and -4 by investment grade companies. And that totally, was a multiplier effect, let's say, on Europe. And so Europe's job growth moved very slowly relative to the United States. And this financial, quote, technology, access to capital for small and medium businesses inhibited somewhat of the job growth in Europe. But the technology and the knowledge, everyone on this panel is fully knowledgeable of European markets today and active in European markets, has offices in Europe, etc. So Manny, as you think about the potential for Western Europe here, by not only helping out these financial institutions and taking assets off their balance sheet or providing the financing, particularly for small and medium companies, they're going to drive employment. How do you see this interplay over the next 5 to 10 years in Europe? Do you think the repositioning of these assets, the growth of these new financial marketplace firms will help spur growth of small and medium businesses, similar to what we saw here in the U.S.?
Of course, this is a revolution. It takes time. It's like trying to turn a super tanker. Europe was the biggest economy in the world. Today it's not, but with for the ECB especially, they understand how important it is. That's why they're willing to consider having finance companies go to the ECB window. That's why they're willing to have be buying securitized products. So, of course, it's going to catch fire over time, but it does take time. We didn't have our recovery. It took us 4 or 5 years. They just started in 2011, so it will take time. But let me just go to something that Mitch said about regulation. If you look at slide 47, I just want to show you a regulation that took place this week. This is the biggest change in the history of small banks in the United States. In the United States, there's 7,000 banks, and that's the $15.5 trillion of assets. 10 banks are 75% of those assets. There's 6,000, almost 5,800 small banks in the United States. They're private, they're public, they're even subchapter S. The Federal Reserve Board just put in a new rule, it's not even in effect yet, that says, look, if you're a bank under $1 billion, normally you would run with 10% equity capital. You know what you can do? Because they want to have them all consolidated. They're tired of all these little banks. They said, if you're a small bank, you can issue sub-debt and count it as equity. Not just 1-to-1, not just 2-to-1, but 3-to-1. This is a revolution. This is going back, 1,000 years in a sense. So every single small bank in the United States, there will be a massive consolidation. It will begin because this rule will go in effect in May, and any small bank in the United States or any entrepreneur will be able to do what Leonard does with the industrial companies, or what you do in mezzanine. You're going to be able to do this in small banks, which is the exact opposite of what really happened since 2008 with all their other regulations. So this shows you how the regulations can move so dramatically one way and even the other way.
1 second on that consolidation thing, because I want to show you slide 29, what happens when you actually...
We have dueling slides here.
when you actually do consolidate. If you look at what's going on to Wall Street, You don't want to talk about balance sheets and capital structure. Look at these inventories. Look at the issuance in the high yield market and look at the inventory that they're carrying. You know what this means? It means, as I said before, more opportunities for guys in the shadow banking system, everybody on this panel, because...
Now, Mitch,
But that's because
well,
Dodd-Frank,
wait.
because Goldman Sachs is a fake bank. It's not a real bank. It became a bank in '08 because it had to survive. Morgan Stanley is not a real bank.
Why is it fake?
What?
Why is it fake?
No, it's not. You have Morgan Stanley deposits in L.A. Where's their branches around here? They're not real banks.
All right, well,
from
what
the
I was
traditional
trying to
point
say,
of view.
wait, 1 second,
So
Manny.
of
What I was
course-
trying to
of
say,
course
Manny.
Dodd-Frank is going to say, look, why should, they're rolling the clock back to the 40s. They're saying, we'll get Glass-Steagall done our way by simply saying you can't do all these
I think
things
we're
with
actually
the capital
agreeing here,
requirements.
Manny.
Yeah.
You wouldn't maybe know it from the way we're interacting on this. But
One interesting statistic. You're
wait,
talking about
John.
fake bank.
Wait. Just let me make one last point. All I was trying to say was this consolidation dynamic may not be very good for our American economy, as you're pointing out that there's so many gaps and cracks in the system. And when the big guys start to, draining their balance sheet, as you said, Goldman, J.P. Morgan, and not providing liquidity in the capital markets, it's incumbent for guys like us to buy securities that are tied to liquidity outside the capital markets. That's an interesting test. That's all
Mitch, but I think the
I just want to say one thing about
Go
something
ahead,
about fake banks and Goldman Sachs, Morgan Stanley. No one feels sorry for them, but we had lunch with the senior management of Wells Fargo last week, and of all the stuff they told us, and you guys may know this, they have 1.2 trillion of deposits on which they pay 8 basis points of interest.
So Wells
Talking
Fargo
about having an asset pool.
Wells Fargo is the biggest community bank in the United States. It
That's
is
a
community
staggering
bank.
number.
right.
Free money, 1.2 trillion.
you still
bank.
have
But they
to
can't do
make a
anything
rate of
with it,
return
right?
on it, John.
They're not
So-
allowed to make loans, so what are they going to? They don't do anything.
They actually do make loans. They loan us money.
To Leonard Green.
Most banks are not lenders. They're just agents. Wells Fargo,
Wells
is
Fargo
a
actually
lender.
is that,
Yeah.
But
All right, we're going to move now.
You want to rein this back in?
No. John, I think, Mitch, when you talk about lack of liquidity, it means someone has an opportunity
Right.
to create a new financial
That's right.
institution. And obviously, business development corps, which don't take government-insured deposits in, and others have different flexibility. John, if I was to ask you 5 years from now, how will Leonard Green look? Will it be the same? Will you be a private equity firm primarily, or do you think you'll diversify?
Well, that's a good question.
you're on tape here, John. Be careful.
Yeah,
now.
yeah. Globally, all my Chinese investors. Look, we have chosen thus far to do one thing and to do it well and to do it in scale. And it's been very successful for us, and we felt we've built a brand over 25 years. But one of the phenomena we're seeing today, as Mike has told us, is there's such an abundance of capital. We're having a lot of our investors call us inbound saying, why don't you do something else? We have so much capital. You've been a great steward of capital. So we're always thinking about that. If we did something, it would be more of a related to what we do. And it wouldn't surprise me if in 5 years we're doing something else. But I don't think us being one of these global supermarkets with 20 offices and 20 products, but we have an interesting skill set in our firm and access to capital, and we have a lot of opportunities that come our way that might be too small or too weird or too this. So certainly there's a chance for something else, but our core business will remain, what it is, because even the beauty of our model is we have such flexibility in our current fund, and we still feel our business is scalable, so we can see a lot more opportunities to do it in a bigger way than we've done thus far.
Mitch, Canyon?
5 years from now? Well, I just turned 60, so that means 65, right? And
To me, you'll always be 30, Mitch.
I don't know if that's good or bad, Mike.
Mark, that makes us 27, Mark.
So, look, I think that, in the shadow banking system, you see all types of models. As a matter of fact, one of the things that we do is invest in
Now, for those that aren't familiar with the term shadow, doesn't mean
Okay,
negative.
yes, for the global markets out there, shadow banking refers to alternative credit or other forms of financing markets outside the banks, which is, by the way, has reached over 75 trillion. So my point is, if you look at those participants in that alternative financing part of our financial system, there are all models, some small, some large. As a matter of fact, one of the things that we've done is to try to understand how to invest in the changing financial landscape. As I said before, sometimes you buy losers that you think can become winners. Sometimes you try to pick winners that are undervalued because of their complexity. For example, Blackstone. We think Blackstone is one of the great alternative asset managers. They keep, playing a role, the way you said, in a wide way. Their assets under management are growing really at rates that I don't think are properly valued in the marketplace. We can't be a Blackstone. I think Josh and I have a certain comfort zone, even though we do extend what we try to do. As you said, take our skill set, try to extend the boundaries of it. And that's what we've done. I'll give you one example, and I'll turn it over to the other guys. Structured finance. So we have a CLO business. As Mike, I think on slide 28, Mike has, there was a slide from our London time together. You pointed out how resilient the CLO structure has been versus the residential mortgage-backed securities. For us, they were both opportunities. We have a CLO business, which withstood 2008 very well. We've ramped up 3 deals over the last 12 months. Residential mortgage-backed securities didn't fare so well, but that became one of our biggest asset classes. We had a specialized fund in addition to our other hedge funds. The specialized fund returned 26% over its life. Huge opportunity, whether you're a winner or a loser, depending upon how you look at it. So we do extend our skill set, and that's what we've been doing.
Manny, I would say that you understand most financial institutions better than people that run them. You have a better vision of where they're going than they do. EJF, do you think you will ever just buy a financial institution, maybe outside EJF, so that you can take that skill set to them?
Not a regulated one. But just to follow up what Mitch said, Blackstone is the biggest shadow bank in the United States, the biggest finance company, it's the biggest beneficiary of all these changing regulations. But all of us up on this platform are also shadow banks. We're just smaller shadow banks. And we've also benefited from the collapse in 08 and 11 in Europe. And we would never buy never buy a bank. We signed 200 passivity agreements already on positions we hold through TARP or TRUPS. But to own a bank puts you under phenomenal regulation and also phenomenal personal risk. So to me, that is not an interesting way to go. I want to be Blackstone.
Mark?
Well, Creston for 24 years has lent money to companies, and Jean-Marc and I, Jean-Marc Chappis, another managing partner at Creston, have focused on, as I think several folks on the panel have here, on our core competency. That said, I think we need to scale our business because firms like Blackstone and other large firms are trying to push some of the little guys out. I don't want to, put it on any one name firm, but if you look at risk retention rules, for example, that are finding their way into the CLO market, they're an impediment to smaller firms issuing CLOs. So we're going to want to continue to grow to sustain our strength. And then we may move into real estate. You can hear the opportunities that Mitch and John have talked about today in capital market arbitrage, and we'd like to be able to participate in that as well. But it would be real estate lending, not real estate equity investing.
Well, I want to thank our panelists for joining us today. We've had a tour de force around the world, and I think there was a lot of opportunities. The message we want to leave you is you have to have knowledge in what you're doing, and luckily today we had 4 of the most knowledgeable people in the world with us. So thank you for joining us.
Thanks, Mike.
Thank you.